July was a quiet month on the surface and pretty revealing underneath. In this P2P lending portfolio update, I will unpack some of the changes I'm currently making to my P2P lending portfolio. So let's get right into it. If you're new here, you should know that every month I extract my portfolios, aggregate them, and give you a quick walkthrough of every platform I'm invested in, share with you the real numbers, wins, and losses. So this is how the portfolio looks at the beginning of August. The outstanding portfolio amount increased to 164,000 while generating 1,233 euro in interest. In this table, you can see the changes compared to the last month. PBER is the largest position in this portfolio with roughly 36%. The platform generated 513 euro in interest with the outstanding portfolio of close to 59,000 euro. About 38% of this portfolio sits in Poland, which is backed by a buyback guarantee but no group guarantee. Going forward, I aim to decrease my stake in Poland so the entire portfolio is backed by a group guarantee as well. There is nothing concerning to report about PBER this month. Everything continues to work as expected. Investing on this platform is boring, predictable, and on schedule, which is exactly what I want from my largest position. I managed to sell another loan on Guru with a significant discount, which cost me about 173 euro in fees and losses. This has again reduced my position on the platform. Currently, I put all my loans on the secondary market with an 80% discount. My expectations of Guru recovering anything are at all-time low. Luckily, this is a rather small share of my portfolio, so an exit is more or less a cleanup of bad loans. The second largest holding in my portfolio is TD Funding with about 21,500 euro. This platform generated 257 euro last month. The interest is being reinvested. Currently, there are no delayed loans in my portfolio either. It is quite similar to my position on PBER. It's not exciting, it's pretty boring, and it just works. An interesting point in my Triple Dragon funding portfolio is that the funds are distributed into loans issued in Canada or the UK, which helps with my country diversification. My position on Fintown did not change in July, however, I've decided for myself that I will decrease my exposure here. The platform has not released any updates in the past half year, although updates for the last year are expected to be shared in August. From my point of view, this is not good enough. The platform has been financing several projects and it should have released operational updates on a regular basis, not only when it needs funding. Hence, my exposure here will definitely drop to sub 9% of the entire portfolio. From an investor standpoint, the platform continues to pay interest every first of the month, so there is nothing negative to report about interest payouts or withdrawals. On CrowdPeer, I actually increased my exposure. The outstanding portfolio sits currently at 11,000 euro. I have to fix one of the errors I reported last month. The defaulted project Drobes Butas is actually a B-rated project. It also hit my portfolio, which increased my default rate on the platform to 28%, as my exposure here was the largest single loan exposure so far. The platform terminated the agreement with the borrower at the beginning of July. Currently, the project earns 5% annual interest on top, which will be repaid when the loan is recovered. How long it's going to take to recover the loan is currently unknown. As for myself, I expect at least a few months. Moving on to Lande, where several loans have been recently repaid and I did not have time to yet redeploy the returned principal. About 23% of my portfolio is delayed and about 4% is in default at the moment. These days, I usually aim to stick to just Latvian or Lithuanian loans with a relatively shorter time period. I also tend to check the borrower's history in case they have already funded other loans on that platform. My goal is to redeploy the available funds and just let it compound. On Indemo, there was another loan that was repaid last month, but since my exposure to that specific loan was minimal, the capital gain did not really move the needle. However, for August, I already saw another repayment with more favorable capital gains, so it seems like some of the debts are finally moving in the right direction. I will report the final numbers for August next month. There has been no real change on Income Marketplace. The loan continues to perform as expected. Afranga has paid a good interest last month, about 210 euro. Going forward, I am also decreasing my exposure here to sub 9% of the portfolio. Afranga has recently published the audited sticker read report for 2025, which shows a significant amount of funds being lent to related parties rather than used for the sticker read consumer loan portfolio. While their amounts in related party loans have decreased over the last 6 months, the 2026 interim report, which was just published recently, shows about 32% of total assets being used as related party loans. I asked Afranga whether they have insights into how those funds are being used, and they said no. So basically, there is a chance that investors who fund business loans on Afranga are not funding the consumer lending portfolio, but are funding unsecured business loans to related parties, which changes the risk perspective quite a bit. Additionally, the lender is reporting an increase in impairments, even though they have changed their methodology. It's not lowering the risk for investors, it's right the opposite. While Afranga and StickReady have been able to historically repay all loans without any issues, as you might know, historical performance does not guarantee future outcomes. Based on the recent developments and the access to information that I have, I'm not so comfortable having even 10% of my portfolio invested in this lender. Investing in Afranga should basically be treated as a single lender investment with somewhat opaque transparency of how those funds are being used. So perhaps some satellite position in this platform could be justified due to their good track record and regulation. A larger investment is very hard to justify, especially if you are a risk-cautious investor. Additionally, most of the highest yielding loans will lock you up for at least 2 years with currently no secondary market. The platform has recently announced enhanced liquidity for the Smart Safe product, which will allow you to exit 30% of your exposure while paying a 1% fee. This entire product may not be so competitive when it comes to the risk and return ratio. While the Afranga platform has made good improvements in terms of their product and simplified the investment experience quite a bit, a simple product does, however, not equal a safe product, which is something that experienced investors probably would agree with. Alright, so let's move on to Nectaro, where I'm invested with about 10,000 euro. My interest and principal return are simply being reinvested. I'm reporting some portion of the portfolio in pending payments. For my internal purposes, I classify it as funds in recovery. Nectaro does not share the amount of pending payments on the public statistics page, so there is no reliable way for me to report it in the monthly portfolio performance updates. So here you can see the reported P2P lending portfolio. PureBray has the largest share with about 46%, followed by Triple Dragon Funding with 13%. Most of the other platforms are below 10%. The portfolio is diversified across several countries, mainly Spain, Poland, Bulgaria, and the Czech Republic. I aim to improve the diversification and decrease the largest positions a bit, so it is a bit more diversified. Most of the portfolio is allocated to commercial loans, followed by real estate and rental deals. About 90% of the portfolio is current, with about 5% delayed and 4.4% in default. The defaulted share actually jumped by almost 2% in comparison to June, mainly due to the default on CrowdPeer. When we look at the securities, 63% are unsecured loans backed by a group or buyback guarantee, or both, and about 47% are secured loans which are backed by mortgage or some sort of collateral. The weighted average interest rate is 11.66% spread across 202 loans in 17 countries, with an average of about 813 euros per loan. If you have a larger portfolio and you're an experienced investor, you probably know that the biggest risk in P2P lending is the stuff that you don't see or are not aware of. So while this portfolio is definitely not perfect and you can see some of the loans defaulting, at the same time you kind of know what to expect, which I think is a better position to be in than investing on platforms where you have no insights into anything. The only information you have often available is how much cashback bonus you will get, which is quite frankly not a good reason to invest. High yield chasers have historically lost the most money in P2P lending. Recently, I've seen a growing number of videos steering investors towards unproven and highly speculative platforms. Some creators openly acknowledge that these opportunities are closer to gambling than investing. yet still encourage viewers to participate for affiliate links in exchange for cashback bonuses. Anyone considering such platforms should understand the profound asymmetry involved. The person promoting the investment does not bear the consequences of your decisions, and their financial position may be entirely different from yours. Affiliate commissions can offset or even exceed the creator's own exposure into questionable platforms. The ordinary investor, by contrast, risks losing the entire deposit while receiving little meaningful compensation for assuming that risk. A cashback bonus does not make a risky investment safer. It only makes the offer look more attractive, while your risk of losing money remains exactly the same. So that's it for this month's portfolio update. If you like this video, hit the like button and subscribe. Do not miss out on future videos. Thanks for watching, and I will catch you in the next one.